यार मैप के अकॉर्डिंग तो यहीं कहीं है, थोड़ा आगे देखते हैं।
अरे सर, घर चलते हैं, मुझे थोड़ा डर लग रहा है।
यार होना तो यहीं चाहिए। लेट मी जस्ट चेक।
सर, ये आपने आवाज़ सुनी?
अरे ठहरना यार, पहले ढूंढने तो दे। एक मिनट, टॉर्च पकड़। हाँ दे 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 दे, स्पीड दे। मिल गया मिल गया मिल गया मिल गया, आई गॉट इट। चल चल, मिल गया यार।
सर, वो क्या है सर?
क्या है उधर? अरे वो देख रहा है तू? अरे चल भाग भाग भाग, अरे भाग भाग भाग, अबे रन रन रन।
हेल्प, बचाओ।
हेल्प बचाओ, हेल्प हेल्प। Okay, thank you doctor, thank you very much. So unfortunately my videographer is still in a state of shock, but we found what we were looking for. So this envelope here contains the secrets on why almost every equity scheme of Quant Mutual Fund is doing extremely well. The information here has been collected by examining write-ups, articles, interviews and videos, and is the work product of many hours of analysis and debates. But the important point is, let's not look at this video just as an information exercise. Instead, let's understand it more in terms of what we can learn from Quant Mutual Fund's unique strategy and how we can apply it in our own investing frameworks. So keep an open mind, be a student for the next 15-20 minutes, and let's begin. It was exactly an year back when I first researched and made a video on some schemes of Quant Mutual Fund. Since then, a lot has changed in terms of geopolitics, inflation, oil prices, China, technology stocks, etc. But what hasn't changed is the dominance of quant schemes, with most funds of theirs topping the category charts and handsomely beating the benchmarks. I think a lot has been said and written about the amazing performance of those schemes, so I won't spend any more time on that. But one reason why I wanted to revisit my previous video is to challenge this notion that some people have that this fund house was downright lucky to do so well, or they took unfair advantage of the bull market, etc. I think the more recent performance in 2022 has built up a lot more equity and respect for them from their investors and distributors. In fact, our dossier here has identified 5 secrets to Quant Mutual Fund's style of investing, and the rest of this video will be about understanding what they are doing differently and why is it working so well for them. Okay, I'll start with something which sounds like a management model that's taught in B schools, but the VLRT framework defines how the schemes of Quant Mutual Funds operate. The 4 letters represent valuation, liquidity, risk appetite, and time, which form the 4 pillars of Quant's investing structure around which every decision is made and modified. The point one has to appreciate is that the fund house uses very distinct variables when designing its investment portfolio, and that's where a lot of the skepticism also comes from. Because our brains are used to bracketing funds under different categories, like this is a growth fund, this is a value fund, balance fund, large cap fund, all weather portfolio, etc. So this is where Quant's investing style seems to be different, as they combine qualitative, quantitative and behavioral aspects when designing their portfolios. In fact, Sandeep Tandon, who's the founder and CIO, defines the fund house not as an asset management company but more as a data analytics firm that is constantly looking for numbers at signals and trying to predict what the future will look like. Actually, Mr. Tandon uses this word predictive analytics in most of his interviews, which is something Jim Simmons and his hedge fund Renaissance Technologies, or Rentech, is famous for. If you haven't heard of Jim Simmons or Rentech, then I strongly advise you watch these 2 videos, which will open your eyes to this magical world of mathematics and investing. So predictive analysis is the backbone of Quant's investing strategy, which creates a picture of the future based on multivariate model comprising of valuation, timing, risk appetite, global macro factors, liquidity, behavior, etc. This might be getting a tad confusing, so let me explain how a multivariate model might work with a simpler example. So say you want to figure out the price of a football club. Now the most common way of doing this is to use an earnings multiplier. So if a club earns $100 million in profits, then a 10x multiplier gives it $1 billion in valuation. But if we take this a layer down, then one would realize that the profits are a function of the league that the team plays in, the broadcasting rights, the stadium, and most importantly, the players. Now, within players, a strong multivariate model would set up a third layer of analysis, which includes variables like the age of the player, his fitness, the number of years left in the contract, interest from other clubs, the style of play versus the position the manager wants him to play in, etc. So this is a crude example, but I hope we can appreciate how deep and broad a multivariate model has to go in order to give the fund an acceptable prediction of the future. As a matter of fact, I found a slide in one of Quant's presentations which explains how the fund house looks at these scenarios. So in the words of Sandeep Tandon, in March of 2020 when COVID struck, global risk appetite was at a depressing low and global liquidity was at a lifetime high, which presented a lethal combination from a bull run perspective, which is exactly what happened, and the Quant Mutual Fund schemes made a lot of money for the investors. Likewise, in September, October of 2021, their VLRT model spotted a euphoria situation indicating that the bull run's easy phase was over and the momentum is likely to shift from growth stocks to value stocks. So a lot of what the Quant team does hinges on this VLRT framework, whose job is to feed them signals on how the macro environment is going to behave in the coming few months, based on which the team can take buy or sell calls on different sectors and different stocks. In the video where I explained how I designed my investment portfolio, I spoke about Prashant Jain and Jinesh Gopani, who are very disciplined about using the value and growth strategy respectively. I mean, yes, there is some growth in value and some value in growth, but the predominant style of these fund managers and most fund managers is the one they believe in. And that's where I think the schemes of Quant Mutual Funds are a lot different. You see, Mr. Tandon categorizes his fund's investing style as dynamic and unconstrained, which means these schemes are more than happy to change their style from value to growth, from momentum to coffee can, from large caps to small caps, and they do this without any kind of emotional baggage or affiliation to a particular style. For instance, notice how the Quant Active Fund has hardly continued with the same set of companies on a half-yearly basis, which shows its freestyle approach. Although I must say, over the last 1 year, the scheme seems to have stayed with a few larger companies over longer periods of time, and we'll address that later in the video. To put it together, Quant's operating style is to keep data at their core and to the extent possible remove any human biases or sentiments that might creep into stock and sector selection. Another interesting aspect of Quant's dynamic style strategy showed up when Mr. Tandon said, and I quote, "Pure valuation analytics doesn't help because it just gives you an entry point but never gives us the right exit point." Now, it's very difficult to disagree with a statement like this because a lot of what we have heard and read from a Warren Buffett, a Monish Pabrai, the coffee can style which we covered in a video, Peter Lynch's investing strategy, was almost always about how to identify the right stocks to buy, but not enough time was spent on explaining when is the right time to exit a stock and book profits from it. In my opinion, the single quality of knowing how to time the entry and exit has been the biggest contributor to the overperformance of all quant fund schemes, which essentially means that the buy and hold strategy does not find favor with the quant team, who thinks of it more like a unidirectional approach and is bound to underperform on many occasions, sometimes even for a prolonged period of time. On the other hand, Quant is very open to changing to a different strategy if it can offer a better bang for the buck for its investors. Another prominent characteristic of quant schemes is their high portfolio turnover ratio, with many of them operating at a churn rate of over 700%. Now, majority of people look at a high portfolio turnover as a bad thing, and that's probably because we have read it somewhere or watched it in a YouTube video that high turnover means more expenses and more expenses means less returns. So that's the traditional mindset. But we've also seen that there is nothing traditional about how Quant runs its schemes, and their dynamic style of investing makes portfolio churning an intentional exercise, as it not only helps them deliver better returns, but by moving in and out of rising and sliding trends, these schemes also end up reducing the portfolio's volatility or risk component. In fact, I did a little side research, and specific to the US markets, this correlation between portfolio turnover and portfolio returns has reduced quite a bit and has even turned negative. This change in trend can be attributed to a couple of reasons. One, a significant reduction in the transaction costs, and secondly, modern risk management tools which have become a lot more sophisticated. But does this mean portfolio turnover doesn't matter? Well, I don't have a perfect answer to that at the moment, but from what I have read so far, it seems the chatter around Quant's high portfolio turnover is just noise and it's rather harmless. So personally, I like to keep an open mind around this and give the benefit of the doubt to the Quant team. By the way, I should also mention that the portfolio turnover rate is also a function of how the stock markets are behaving. So in a rising market, the churn rate is generally high for most mutual fund schemes, and this number drops when the markets are falling or in a state of high volatility. Another secret to Quant's investing philosophy I found fascinating is how they apply behavior to valuation. So traditionally, valuation is understood in terms of specific metrics like the P ratio, the price to book ratio, the PEG ratio, EV to EBITDA, etc. And that's how most of us use and apply it in our own investing framework. But here's how I think Quant does it. So data points regarding public sector banks or PSUs is readily available, and I'm just taking PSU banks as an example. Now let's say a lot of them are available at an attractive valuation, but if we look at it from a behavioral point of view, then it's also a sector where many people have burned their fingers, and for these people, PSU banks have practically become untouchable. If you put this in a B School 101 graph, then I think what Quant does is to identify an inflection point where the valuations are still low, but that hatred towards that sector is no longer there. When does something like this happen? When there is positive news of GDP growth, credit growth, reduction in NPAs, increase in the net interest margin, etc. These inflection points are those time periods when the probability of losing capital is pretty low and the upside opportunity is pretty high. The way I look at it is that it is not enough to identify a stock or a sector which is totally beaten down and has attractive valuations, but good investing also requires us to understand how and when the behavior of investors is changing, because that's when a lot of these stocks get re-rated. So again, this is multi-dimensional research which Quant is good at, and as it stands, the fund house has a substantially large weightage in PSU banks in its portfolio. The fifth secret that is uniquely Quant is their understanding of macroplays, that is what is really happening at a large scale, but it is so large that most people are ignoring it. For example, and I heard this in one of Mr. Tandon's interview where he explained how there are early signs of substantial money moving from the United States into India, and that this trend is likely to gather momentum, if not in 2023, then maybe in the year 2024 or so. This trend, if it fructifies, would position India as a new asset class, a lot like what happened to China many years back. In that same line of thought, I think Quant also looks at what is happening in other territories and where the money is going to and coming from. And it makes practical sense to do this exercise, doesn't it? I mean, look at Europe. Now, one has to think logically, who is going to make investments in that region? Probably not many. And if not Europe, then where are those billions of dollars going to go? And which country and which sector is most suited to capitalize on that big microplay? These are the kind of discussions that I think are fed into Quant's investing framework, which together with their dynamic style of investing and understanding of the behavior side turns their thesis into an actionable plan. And there are lots of macro plays available. For example, there is manufacturing, and Quant as a fund house is very bullish on it from an India perspective, and one can see that in their schemes portfolio as well. Then there are large scale areas like housing demand, especially rural housing demand in India, global supply chain, exports, renewable energy, healthcare, etc. So these are 5 secret ingredients that the Quant Mutual Fund team uses to serve up a spicy and delicious dish. Actually, it gives a higher return. And since this is a young fund house, I think we'll all continue to question its performance for a little more time. But I hope this video has given some idea on how I think the fund house operates. To put it simply, this is a fund house that is not married to a particular strategy, has a clear framework on how it wants to operate, uses data extensively to the extent that it calls itself a data analytics company, applies investors' behavior on top of valuations, looks for the next big play at an Indian and global level, and absolutely embraces volatility. I'll continue to gather more information about this fund house and others, and probably in a few months I'll have a strong playlist for you. In the meantime, do watch this video again for better retention. Please like this video, subscribe to my channel. Please pray for my videographer, and I'll see you next week. Until then.